sort of the halcyon days are over.
And to be clear, because you are obviously known more of as a bond person, but now you can kind of do what you want. You've talked more about stocks the last few years since moving over to Janice Henderson. You're talking about the U.S. stock market reaching a potential top, correct?
I am. I think other global markets are more appropriately and fundamentally valued, Europe, for instance, and some emerging markets. But I think the U.S. is ahead of the pack, so to speak. And again, not that things are going to go down precipitously, but I think we're basically at a peak. Maybe it's a permanent plateau. Remember that one in 1929. But in any case, I think the double-digit increases are over simply because the credit cycle itself is pulling back. The Fed's raising interest rates. The Fed is reducing its balance sheet. The ECB is going to reduce its balance sheet by half and ultimately raise interest rates. And so, these are slight negatives that argue against a continuing bull market.
We've talked in the past about this flattening yield curve, and I don't want to get too in the weeds. Obviously, that's the difference between the 2-year and the 10-year. It is flattening. It's not inverting. It's flattening. We've talked on CNBC today extensively about the junk bond market as well. Is there anything that you're seeing in the bond market that could be viewed as a warning sign, a siren, a bullhorn, whatever it is, for equities, Bill?
Well, nothing quite yet in terms of developed market and government markets. As you know, they've been relatively stable for a long, long time, although the Fed is raising short-term rates and that curve is flattening. I do think and agree to some extent in terms of corporate debt and mainly junk debt. It's confined at the moment to telecoms and to companies in that area. But junk bond spreads are widening, and sometimes it's an early indication of equity prices. Usually the two move together. The correlation historically has been that the stock market moves 4 times as much as the high yield market in terms of price. And at this point, the stock market is only 1% off its peak, and the high yield market is about 3 or 4% off its peak. So it's simply gone the other way. But yeah, I'd look at the high yield market as an early indicator.
Every day we seem to get by.